Hello students and welcome to the lecture. So students, as we know that we have started the financial knowledge program, and in the previous lecture we had started with the banking history. Okay. So basically in this lecture we are going to continue with the financial knowledge and the banking awareness and with the same topic of the banking history. But we will look upon several other facts and figures. Okay, I hope that you have revised the previous lecture before you have arrived for this lecture because it's for your own benefit. Okay, so let's start this lecture. So now we are going to start with the establishment of the modern banks. In the previous lecture, we had discussed about the early banking practices. In this, we are going to start with the modern banks. Okay, so student, the first modern banks in India were set up in the 18th and the 19th centuries. Bank of Hindustan and the General Bank of India were among the earliest banks. Alright. So if you remember, in the previous lecture, I had told you one thing. What was that? If we divide the Indian banking history in two major portions, so the first portion is pre-independence era from 1770 to 1947. Right? Second one is our post-independence era, which was from 1947 to till today. Okay, and then we had seen a divisions between the pre-nationalization, then nationalization to liberalization, and then post-liberalization. Okay, that was we had discussed in the previous lecture, right? So basically, when I told you that the ancient Indians were basically known to the banking practices, then why didn't I say the Indian banking history starts with the ancient times? Why? What was the reason? The sole reason was only some kind of banking practices were in economy. Okay, but there was no proper institution to carry out banking activities. All right, so there was only some kind of banking activities, like we had seen the bills of exchange was there. Okay, the loan facilities were there, and even let me tell you one thing. In the ancient times, we had a system of shrenis. You know what do you mean by the shrenis? Shrenis are basically the religious and socio organizations which generally work as a banking to the traders. They also work as a banker to the traders. Okay, they grant them loans, they accept their deposited and donations, even they made the investments. So you can say the proper banking institutions were not there in the ancient time. We had some kind of banking practices. Yeah, I'm agree with you, but not a proper banking institution which is specially designed for accept the deposits, making the loans, making the investments. Okay, and all other banking practices we see today. Okay, so basically this was happened during the year of 1770 when the Bank of Hindustan was established. Okay, that's why the Indian banking history pre-independence starts from 1770 to 1947. Okay, and then we had two banks, Bank of Hindustan 1770 and General Bank of India. So if we talk about them, so the first bank is Bank of Hindustan. That was founded in 1770. Okay, and basically that was the first Bank of India and was under British control, or you can say was under European management. Most appropriate. All right. However, the Bank of Hindustan could not sustain for long, and that was the year of 1830 to the 1832 when the Bank of Hindustan was liquidated, or you can say was closed down. It could not sustain for a long time period. Founded in 1770, ended in the year of 1830 to 1832. All right. Thereafter, the next bank we have is the General Bank of India. That was found in the 1786, and that was liquidated, or you can say shut down, in the year of 1791. Even this bank could not sustain for a long. Okay. Thereafter, we had the Britishers. As I had told you in the lectures of history, that the Britishers were keenly interested in monetary economy. Right? That was I told you. Because before the Britishers, when we had the Mughal era, and you can say Delhi Sultanate, and even the Maurya and Gupta periods, whatever the time period we have on that times, one thing was very common, that the Indians were not used to have a money. Okay, they were basically practicing the barter system. Okay, even the state, or you can say the king, or you can say the royal organization, even they were collecting the tax, collecting the tax rarely in money, but oftenly in produce. Okay, even the government was not interested to get a tax in the money form. Even the government was collecting the forest produce, you can say the agriculture produce, as 2 by third, as 1 by third. Okay, so that's why when the Britishers arrived, and they were barely arrived to do a trade. Okay, and their trade practices were somewhat different from the Indian traditional trade practices, because the Indians were doing the barter system. It means that if you want something from me, you must have something which I want from you. Okay, it means that if that person having the shoe and that person wants the apple, so he has to search a kind of person who is having the apples and willing to take the shoes. Then only the deal could be made between them. Otherwise, there will be no deal. Okay? So when the Britishers arrived, they had the ambitious plans with them. Like they want to grow their East India Company, they want to grow their shipping industry, their manufacturing industries, because after the industrial revolution, the Britishers were making or searching the ways to sell their products. All right, because in the Britain, when the industrial revolution introduced, okay, so you can say the British domestic market only having demand for 80 units, okay, but their market was producing 200 units. Just an example. Now you can see how much the production exceeded the demand. It means that there is a condition of deflation, okay, or you can say there is a condition of rapid fall in prices because the supply is heavily dominates the demand. All right, that was the reason why the British wants to sell out their excessive units in the world market, because right now they had the excess of 120 units. Okay, they could not dump this kind of goods in their market because already their market is under pressure of the supply. Okay, over pressure of the supply, you can say. So that's why they were trying to sell out the things in the different markets, and India was one of the biggest market they found. But the condition is that when they came to India, they saw Indians were making trade in barter system. Okay, and even the Europeans other than the Britishers, like the Portuguese, like the you can say the Dutch, okay, when they were doing the trades, they were also following barter systems. Like, let me give an example. Portuguese, right? They were the first Europeans to arrive in India. Okay, they were actually exchange their gold and silver with Indian merchants in return of spices. Okay, they were exchanged their golds and silvers with Indian merchants in return of spices because the spices were greatly demanded in the European market. But the gold and silver were not as appropriate thing which you should change for the spices. That's what the Britishers understood. Then the Britishers tried to replace the barter system with the monetary system. That was their planning. Okay, but that was not so easy because the Indians with whom they were dealing, the Indians were well known to the barter system than the monetary system. Okay, so that's why they imposed the taxes in money. Okay, thereafter they introduced the loans in money. Whatever they could, they tried to do it. But one thing happened which is negative for them. It means that Indians were not liking the money because they were becoming insolvent. When the monetary system was tried to be imposed by the Britishers on the Indian crowd, instead of liking the monetary system, started hating the monetary system. Why? Because they were becoming the insolvent people. And how it was happening? Because there was a predatory loans. Okay, now let's try to understand this picture clearly. That is the farmer or the person. All right, government asked him to pay rupees 10 as a tax to the government. All right, prior to the Britishers, he was paying the tax as 1 by third of his produce. Whatever he is producing, he is paying one piece of it to the government as a tax. But the Britishers asked him to pay the money, not the produce, to shift him from the barter to the mortgage system. That was they were trying. Okay, but there was no money circulation in the market because the Indians were not familiar with the money, and even there was no authority which could ensure the regular supply of money in the market. Okay. Second, there was no loan facility available in the market. Okay, from where they could take the loan on logical basis. So what they had to do? They had to move to the person who is known as the Sahukar. Okay, and you can say they were basically the money lenders who used to give them the money so that they could pay the tax and discharge their liabilities. But in the previous lecture, I had told you the predatory loans were given on the high interest rates. And if we take the example of the previous lecture, then rupees 10 was taken as a loan, but rupees 40 has to be paid as an interest, right? Now assume the condition. The farmer who had taken a loan, he didn't make anything productive. He just pay his taxes and the liabilities to the government. He didn't start any new business. He didn't start any new venture so that he could earn more and more. Okay. He did not have rupees 10 to pay. And now we are asking him to pay rupees 52. The principal amount plus the high interest rate. So what will happen? He is not able to pay it. And the money lender who provided him the loan take over his property. Okay. Due to this, over time, there were so many clashes. One side is the farmers and the local peoples, another side is the money lenders. And this gave a proper picture in front of the Britishers that without dealing with this situation, they are not able to shift the Indian economy from the barter to the monetary system, which they keenly wanted to do for their own benefit. Alright, not only the farmers, even the traders and the merchants who are a potential candidate to pay a huge and regular taxes to the British government were becoming insolvent because of these two factors. Because even they were not able to pay this kind of interest rate to the money lenders. Okay, that's why finally, after the consideration of many years, the British East India Company established the Bank of Bengal in the 1809. Bank of Bengal. Okay. Then the Bank of Bombay in 1840 and the Bank of Madras in 1843, which later merged to form the Imperial Bank of India 1921. Okay. So basically all these banks, if you looked at the Bengal, Bombay and Madras, what is the common thing you notice in them? I'm giving you 5 seconds to think about it and tell me what is the common thing you notice in them. 1, 2, 3, 4, 5. That's it. Nothing you have noticed, right? But let me tell you one thing. If you say this, all these are the banks, then it's not right. Okay. If you looked at the Bengal, Bombay and Madras, they all were the presidencies. British presidencies, you can say. Okay. So when the Britishers established the banks, they first focused on the presidencies. Okay, because they were their main economical, or you can say economic centers. All right, that's why their main interest in setting up the banks in these presidencies first was that. All right, okay, but the Britishers were not the one who did this. Okay, Portuguese, Dutch, French, they were also the prominent powers in the banking field in the Indian economy. And what was actually happening on that time? These banking or these European powers were not only fighting to establish their controls and making their control the population in a habit of monetary system, but these banking powers were also financing the traders and merchants. Okay, they were attracting them towards their bank sector. Okay, and that was the competition even felt by the British power. Okay, so what happened? It was the 1876 when Presidency Bank Act 1876 was passed by the British government. Okay, what this act does basically, this act brought all the three presidency banks under one management and control. All right. So the Presidency's Act of 1876 basically formulated to brought all the three presidencies bank under the one management and control. Bank of Bengal 1809, Bombay 1840, and Madras 1843. All these were under the control of one single management. Let me tell you by example. This is the Bengal Bank. This is the Bombay Bank. This is the Madras Bank. Right? This was controlled by X. This was controlled by Y. This was controlled by Z. All right. X will do something different. Y will do something different. Z will do something different. Okay. So there will be a variation in the decision making. And you can say this is not so good when you want to increase the efficiency in the competition market. When your all three main organs are doing the different things, they are not doing the things in a single way. Okay, that's why the Presidency's Bank Act was passed, and suppose Mr. A has been appointed as a main head of Bengal, Bombay, and Madras. So that's how all the three main presidencies banks were brought under the control of one single management. Okay, to counter the situation. But this is not so enough when we entered into 21st century or 20th century, you can say. When we entered into 20th century, actually the conditions were not so good for the Britishers. Okay, that's why even after putting all the three presidencies banks under one single management, they had to merge them all to enhance their funding capacity and more survival chances. Okay, let me give an example. Suppose these are the three banks of Britishers, A, B, and C. 10, 10, 10. All these 10s are the lakhs. This is their total deposit power they have, or total loan power they have. This is a Portuguese bank. Just example, 20 lakhs is its power. So if we talk about the individual banks, then these banks dominates them all because they have only 20, 10 and it's having 20. But if we merge the all three banks as A, B, C new bank, then this will have rupees 30 lakhs as a loan granting power. And this will blows off the Portuguese bank. That was the idea which established the Imperial Bank of India in 1921, which was later renamed as a State Bank of India. Right? Okay. So this is about the modern bank establishment. Okay. Now, the Reserve Bank of India, RBI. The Reserve Bank of India, the central banking institution of the country, was established on 1st April 1935 under the Reserve Bank of India Act 1934. So basically what generally happened, after the putting of all the banks under Presidency's Bank Act 1876 under one single management, thereafter establishing the Imperial Bank of India in 1921, Britishers were expecting that they were only the single power in the Indian banking institutions and they would dominate the Indian banking economy. But that generally not happened. Okay, even after tried all the options, they felt that other European powers trying to enter in the banking market. Okay, and even the Imperial Bank of India and other banking institutions run by the Britishers and even the Indians were not as good as they were expected. Okay, because they were collapsing rapidly. How, I will tell you in this upcoming lectures. Okay, so that was happening with the banks. All right, and even the other European powers were trying to enter into the banking market of the India. Okay, so the Britishers were in a deep thought what should be done, and then some of them decided that they should made a Imperial Bank of India as Central Bank of India. Okay, that was their planning. All right, and for this they appointed Young Hilton Commission to examine the idea, to examine the possibility, and let the British government know how it could be possible. Okay, so when the Hilton Young Commission established for this purpose, he examined, or you can say they examined each facts and figures. Okay, they examined each fact and figures thoroughly, and then they said, we shouldn't establish Imperial Bank as central bank. The reason was very clear. Actually, the Imperial Bank of India just established to merge the funds of all the three presidencies bank. Okay, but Indian central bank requires more and more conditions to be followed to regulate the market. Okay, to support the banks, to provide a guidelines to the banks and other functions, which were need to be inserted in the Imperial Bank of India, because the Imperial Bank of India was not designed and established for that purpose. If you have to, you can say add the regulations, and you have to add the instruction powers and all those things. So you have to insert these things to the Imperial Bank of India. it will take a time, right? And the competition and the condition of the banking system was worst on that time. So the Hilton Young Commission totally replaced this idea. They said we need to establish a separate bank as a Central Bank of India. And that's how the RBI, which is known as the Reserve Bank of India, was founded in 1934 as a private owned body, right? Remember this thing. When the Reserve Bank of India was established, it was established as a private owned body till its handing over to independent India. Then it became a nationalized bank. Prior to this, it was established as a private body. Okay. And Sir Osborne Smith was the first governor of the Reserve Bank of India. All right. The RBI took over the central banking functions from the Imperial Bank of India, which was somehow functioning as a central bank since its creation from 1921 to 1934, when the RBI Act of 1934 was passed and assumed the responsibility of issuing currency and controlling the monetary policy. Okay, all right. And remember one point also. When it was established in 1934, its headquarters was in Kolkata or Kolkata. Okay. So when the Reserve Bank of India was established, its headquarters was at the Kolkata. Okay. And now its headquarters are at Mumbai. Okay. And if we revise, we know it is the apex institution of India in the banking sector. Okay. So this is about the modern banking practices and the RBI. Okay. So students, in this lecture, we have covered some more facts of the banking history. I hope that you have come to know about various facts and figures. All right. I want you all to revise all the facts and figures thoroughly before you come for the next lecture. Because if you are not doing this on a regular basis and you are watching the lecture just like you are watching the web series, then let me tell you one thing very straightly. All the things will get piled up in the end. And when you try to revise them, I'm frankly and straightly telling you, you won't be able to do it as efficient as you could do now. Okay. And it's on you. If you want to clear your examination, just do it on regular basis, because I'm not going to write down your examination. You are the own person who is going to write your own examination. Okay. That's it. So with this note, let's end this lecture and thank you.